The beauty of an emerging market like India is that you can do that first phase in $2 to $4 million. You can do the second phase in $5 to $8 million. In our space, we can get a proven business model, completely open market, which has millions of customers, and we can build an organization to meet those millions of customers for $10 million to $12 million.
When we talk about impact in emerging markets, we can put many complicated metrics around this, but ultimately it's about creating these opportunities for these people on the ground and saying, okay, what can we contribute? What can we do that people can use this excess financial sector? Clean energy, healthcare. That is where in emerging market, I think the core impact basically happens.
I think the opportunity set and the problem statements, I would say, in Asia are the largest. We have the largest population living in this continent, the most amount of development alongside Africa to achieve in the next couple of decades. So I think from an opportunity set perspective, this is the place to be.
When the world of capital and the general world thinks of them as poor, vulnerable, we were like, no, this resilience needs to be celebrated. The last 20 years went from bottom of the pyramid to entrepreneurial households, and the next 20 years is going to be the dramatic growth and contribution to economies around the world, particularly in the emerging markets, of entrepreneurial households. That's our thesis, that's our hypothesis, and that's the way we see the next 20 years.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. In 2004, you made a fascinating career shift from moving from corporate law to become the Chief Innovation Officer at Unitas. Paint a picture for us. What was the microfinance landscape like in India at that point in time?
It was all largely nonprofit. Institutions were smaller in size. Basically, there were almost like hundreds of these institutions, very, very localized. And that was the landscape. All relatively cash-strapped because of the nonprofit construct, their ability, they were constantly looking for capital and philanthropic capital to be able to push their journey. That was the landscape at that point of time. And I think the goal that we took was few institutions, help them move on to, shall we say, become regulated for-profit finance companies. So you're bringing them into the mainstream in that respect. Then the question is, how do you bring capital, bring in equity so that you can bring in debt and actually build a finance institution focused on microfinance? So very early days, but many of those institutions today have become banks. And it's been amazing to see that journey. But they were nonprofits at that point in time. So that was the landscape.
That brings us to about 2008. Which is a pretty interesting time in history to start anything, let alone an impact investment firm. What made you decide to found Elevar at that particular moment? And was there a pivotal moment that inspired you to start and establish Elevar?
The last year I was at Unitas, this was the year I was Chief Innovation Officer. And as one focused on the innovation aspect of things, I was beginning to sense if you will, a commoditization or the early signs of commoditization of the microfinance product. And I'd already worked with so many of, institutions which became very, very well known and credible over time. And I was itching to say, there's got to be more. As I started to think about that, kind of like, okay, I need to step out, probably go entrepreneurial in some way. And there was a fork in the road for me. I was at a point in what was an emerging impact ecosystem where I could have gone entrepreneurial with a specific goal. So run a company, if you will, and do a startup. And if I had gone down that path, it would have been to do something to do with education, likely education finance, but something to do with education. And then the flip side of it was a lot of folks who I knew, good friends globally, were saying, listen, you're sitting at a point where maybe you should think about actually being a fund manager because you have the relationships to be able to do that. So that was the fork I needed to decide. And I eventually decided to go down the path of being an allocator of capital as opposed to running a company. One, because being an allocator of capital, there was still an opportunity to set up something. So in that respect, even as a manager of money, you're actually entrepreneurial in nature. So that bug was being satisfied. But also it meant that I could bring capital to a multiplicity of companies. So that was a little thought out, that last piece. And then came together with some folks from within Unitas and from outside. I know you've had a conversation with Maya in an earlier episode.
Right.
She was one of those. And there were two others, one of whom was still with Elevar, so Joanna Posada. And we had a very good friend, Chris Brookfield, who was also part of it. So the four of us decided to start this journey. We were a classic barroom joke because an American and Indian, Maya is half Filipino, half German, and Joanna is Mexican in origin. It was an interesting time at that.
Let's start with a high-level overview of Elevar Equity, just hitting things like its mission and main activities and key strategies and AUM and so forth, and then we'll drill down, but just give kind of a overview of the company.
I like to break this down into very, very tangible pieces. So first of all, we like to be the first institutional capital in an entrepreneurial journey. And I think that's important because you can work very closely with an entrepreneur as they build their business out from a very early days. And I think that relationship is a very special relationship. The second is we said that we wanted to focus on what today we call core solutions. We don't want to do any kind of product or service. We want to focus on the products and services where we know the families, households, customers give a lot of importance to. And how do we know that? By their wallet. Where are they spending or where are they earning? So that would be the second piece. We would just go and focus there. And that would be a very important consideration. The third is we said, given that we're going in early, we're taking a lot of risk in some respects. But we said, let's mitigate that. Let's back entrepreneurs with 15, 20 years execution experience so that we can at least look at that execution track record and say, okay, we can rely on that and they can figure something out. So not that we have anything against a very young entrepreneur, and we have backed them. But in the complexity of things, our preference would be somebody with experience, saying that's the area we don't want to take as much risk. The fourth dimension that I think is very, very important is that we're thesis-led. So we spend an incredible amount of time in the field ourselves, and some estimates back of the envelope calculations is that over the last 10 years at a leadership level, it's north of 1,000 days that have been spent in the field. And what are we doing out there? It's not market research in the conventional sense. We're actually just having conversations. It's immersion, if you will. And it's from there that we conceptualize where the priority of the customer is and where we should build an investing journey, so to speak. But over time, we realized that those conversations are very powerful, not just for investing, but also for exits, to determine when to start thinking about an exit as far as the company is concerned. But I think that thesis-led approach, so when an entrepreneur approaches us today, almost invariably, if they're talking about a particular product or service which is very, very core to a household, we have a sense already because of the time that we've spent in the field. So we're then looking for what I call the alignment factor. We believe alignment is very, very important to the journey. So, the staff of a company vis-a-vis the customer, there needs to be clarity of that relationship. There needs to be a certain integrity into that relationship. Between the staff and the entrepreneur and the founders of a company, there has to be alignment. Between the entrepreneur and the investors, there must be alignment. And between the investor and its investors, the LPs, if you will, there must be alignment. So we took a very bottom-up approach. I think almost all capital tends to be allocated top-down. And we said, no, let's go the other way around. Understand the customer needs and aspirations, and what we then subsequently call the Elevar method. We said we'll understand the customer's needs and aspirations, figure out whether a business model can deliver that need, who's the right entrepreneur, and can we scale that business model would be the four legs of the stool that we would try to answer. And if we could answer that, then we would move capital in that direction at a very fundamental level and raise capital to move capital. So that was the construct that I think Elevar is really focused on.
There's going to be people listening who don't know anything about Elevar. To paint the 30,000 foot view, explain your main activities, your key strategies.
Yeah, so 5 funds. First fund was 24, the second and the third were approximately 70, 75. Then we did a 120, and then we did a north of 150 million kind of fund. So 5 funds. The sizes of the funds have been picked based on the fact that the Elevar strategy is to be an early stage investor. If you raise too much, then you start writing bigger checks and your strategy changes. So play to strengths, if you will, and that's the mindset. Themes that we invest in are, we started with microfinance, we moved into broader financial inclusion. So other financial products, whether it is affordable loans, housing loans, or whether it's MSME lending, or school finance, if you will, but financial services, education, agriculture, health. Those would be the themes that we focus on, because those are all the core solutions that families and households need and aspire for, from a quality standpoint and an affordability standpoint. India and Latin America have been our two markets traditionally. That's kind of like, if I were to just break it down into level of tangibility, then that would be the answer.
And your targeted returns?
Within the impact investing space, so we said that we wanted to back opportunities where, in quotes, there is no trade-off between the returns that one aspires for and the impact that you want to create. There must be alignment on that. So let's operate in the quadrant where you have a chance to actually deliver value on both sides without the trade-off. So I think there would be peers of ours who would describe themselves as finance first, and there would be peers of ours which would describe themselves as impact first, and they would accept a trade-off out there. So our attempt from an underwriting standpoint is to say that if I can generate the returns, I'm also creating the impact, and vice versa. So the simple answer we provide when we're, kind of like talking to folks about that question that you're asking about the target returns is, we want to be doing well on both fronts, which means from a benchmark standpoint and from a return standpoint, etc., we want to be benchmarked against private equity, VC benchmarks for emerging markets. And, there are folks who put out those benchmarks, and that varies from vintage to vintage, depending upon the year, because you may think, 17% is good this year, but maybe the benchmark 17% is not good, or maybe it's extraordinarily good. That's how we think about it in overall terms. We don't actually go out and say this is the range within which we think we will be able to deliver. I think our investors understand the risk-reward trade-off, have open conversations, and back us because of that journey, and then we take that forward.
You just mentioned microfinance, but you're not really microfinance, right? You're more equity, no?
We are an equity investor. We may have invested into microfinance companies. So we go to Blue Orchard, they would have provided capital to microfinance institutions. They're not doing the microfinance themselves. Some of the other players, people have done debt to microfinance institutions. People do equity to microfinance institutions. So we were an equity investor. We took an ownership of the company, if you will, of the microfinance institution, which actually did the loans going forward. Now, having said that, we're not microfinance in the sense that the last time we did a fresh microfinance investment was actually 2008. Since then, we've done a range of other financial services investments. Like I mentioned, we've done education, we've done agriculture, we've done health. We have followed the customer over time. So as a microfinance loan becomes a commodity and it's easy then to get, because there is a multiplicity of institutions which are able to do it, then customers start to aspire for an individual loan. And when they aspire for an individual loan, they may want it to actually buy a house or to improve an existing house. So you meet that need. But then they're saying, listen, the priorities are, I want to educate my children. And so education becomes important. The predominance of my activity, because I'm a rural household, is in agriculture. So therefore, what can you do for me on the agriculture side? The biggest driver back into being low income, despite all the work you do from an impact investing, is a health crisis in the family. So how do you address the healthcare need of the family or a member of the family, etc.? So if you look at the entire continuum, we're backing companies which provide these core solutions to households. And the way we think about households, and I think that's an important dimension to bring in, and I know it will come up in any case as a question, call them entrepreneurial households. And that's the language that we've started to use very actively. Because post-COVID, and that's the story in itself, why we call them entrepreneurial households. I'll wait for you to instigate that question.
Microfinance is operating at almost the lowest end of the underbanked or no banked market. You are not really operating at that level, but you're not really impact VC either. Your target market is still underbanked, but at a level where people have demonstrated a certain amount of ability or experience.
So let me just tell you our perspective. 20 years ago, what was a microfinance customer is no longer a microfinance customer. That household has moved. The notion that that household could be static would almost make the argument in that case that actually the impact journey has not been that strong. So we have to recognize that these households are aspiring for growth, for prosperity. They're demonstrating an incredible amount of resilience. So what was bottom of the pyramid is no longer bottom of the pyramid. What was low income has moved beyond low income to maybe not yet, maybe middle income. Maybe a lot of those households have become middle income. But I think we have to recognize that the customer moves. And at least in extremely vibrant markets like India and some markets in Latin America and different parts of the world, the customer segment over a 20-25-year time period has made a journey. So my simple hypothesis is we followed that customer. The access issue on their needs has not changed. There is an access problem. It's just what the access problem is different. The microfinance customer of 20 years ago or even 10 years ago does not have an access issue to a microfinance loan. It's easy. There is no point as an equity investor, me going and trying to back another microfinance company because the winners are already well established. Why would I do that? But as a debt provider, it can make a lot of sense to actually go and lend to a new microfinance institution. So from my standpoint, I'm saying, what's the next need and aspiration and product or service that household needs? Because as they've moved, their needs are becoming more complex. And to meet those needs, I have to think about new innovations. I need to think of new kinds of entrepreneurs and companies to be able to meet those needs. So as people go beyond survival, if you will, then they're saying, how do I educate my children better? But where are the quality schools? How do I get healthcare? But where is the quality healthcare? Where is the affordable education and where is the affordable healthcare? And so as that customer starts to graduate, we continue to graduate. That's the context that I think is very, very important to understand. Higher than anybody else. It's just that we're recognizing the shift of that customer.
So you started out in microfinance. And as you say, if you have successful impact, these people don't stay at the bottom of the pyramid. You sought a new market, which was also underbanked as well.
I think the question you asked is very, very appropriate because it is the core of our approach is that the customer segment from today, if you go into the same let's just take India. If you go into the same geography where 20 years ago and you looked at from 20 years ago and look at that geography today, the macroeconomic indicators of India have obviously changed. So you're going to see economic development. But you're also going to see lots of that tangible development at a household level. This is not just some GDP number. At a household level, people have moved. And it's very, very important to recognize that shift. It doesn't take away from the fact that one is still an impact investor. In fact, I would argue that if you are an impact investor, you follow that customer, because it's very important to keep meeting the needs so long as the mainstream is not meeting their needs. If the mainstream is coming in to meet their needs, by all means, you can then say, what's the next problem statement that I want to deal with? But I continue to maintain it's very important, the question you asked, because those needs are not being met yet, because the needs have become more complex, because they're now focusing on the education of their children and the health of the families, which they could not have 20 years ago because they were dealing with how do I just generate more income using a microfinance loan and buying a car.
And now they're moving up the pyramid. All right, so let's talk about Elevar's theory of change. If you can articulate what exactly is the problem or the problems that you're targeting to solve.
The theory of change is that we understand where a household is today and where they want to go. We want to meet that need and aspiration in very, very fundamental ways. So that I've articulated very clearly. 20 years ago, that meant a microfinance loan. Today, it means education, healthcare, articulated clearly also. We will continue to be at the cutting edge through our field visits to understand those shifts on the ground and determine where we want to move capital as a consequence. The one thing we've consistently told our investors and the broader ecosystem is that we can tell you at the point of fundraising where we think the priorities of the firm or that particular fund that we're raising are going to be. But for all you know, within a year or 2 years, the priority that we're articulating today may have shifted and we will have to morph into a new framework of identifying the next level of need and the next level of aspiration. So at a very, very basic level, so long as ultimately anything that we're doing is contributing to either the incomes of the family, an increase of those incomes, or the reduction of expenses. So therefore, their wallet is increasing from an income standpoint, on a net income basis. If you give them quality healthcare, then they're not traveling into the nearest city and it's very expensive because you're giving it to them closer to where they are. That actually has an income impact. So we're really focused on saying, how do we increase net incomes of families at a very, very fundamental level by either addressing the revenue side of the family or the expense side of the family, but only on core solutions, only on the segments that I've talked about. It's as simple as that.
I'm doing my homework for our talk today. I've run into this term entrepreneurial household all over the place. So this is obviously core to your thesis. Can you give me a clear definition of your concept of entrepreneurial household and explain exactly what is its economic potential there?
Through COVID, and as COVID started, I think everybody in the world expected an absolute decimation from a portfolio level, company level, customer level. I think we all expected the pain to be dramatic. And as we started to watch, we recognized while there was a healthcare crisis, which was real, and people were obviously very badly impacted, households were very badly impacted. The reality is we also saw a resilience from an economic standpoint starting to emerge. Maybe families were doing worse off. That's not my point. But we saw a certain degree of resilience which was there. And we decided that we needed to start to understand why that resilience was there. And one of the key factors as we researched that out and spent time in the field trying to understand was a recognition, something that we knew intuitively, but had not called out very clearly, even internally, is that there were multiple sources of income within households. This is a very emerging markets concept. So you go and talk to somebody who's within the customer segment that we want to impact in any emerging market, and you call yourself a Renaissance man, and I'm sure you've had many opportunities.
That was a joke.
No, I'd like to believe both of us are, so why not? Let's go with that. So
I was being facetious.
but the multiple sources of income, is it right? So, maybe the father earns something and he has a job, and maybe the mother is doing some activity from within the household or steps out of the house, has a job of her own. Maybe there's a brother who's doing something else. Maybe there's a child who's doing something. One member of the family has gone to the city and is working out there. And they tend to operate with these multiple sources of income. So when COVID came and some sources of income got impacted, other sources of income became important, or a new source of income was started, or new economic activity. And that led to resilience. Now, when the world of capital and the general world thinks of them as poor, vulnerable, and you have all that language, we were like, no, this resilience needs to be celebrated. How do you celebrate that resilience? Because it's very, very factual, but it's counterintuitive to people. So we said, well, what is that resilience all about? It's entrepreneurial activity. And so we said, okay, fine. Since it's a household as a unit, not as an individual as a unit, let's call them entrepreneurial households. So it combines all the qualities of entrepreneurship. You've done many conversations, and we all know what entrepreneurship is like: risk, comfort with ambiguity, X, Y, Z, all those parameters. These households are showing the same thing, but we will call them low, income. We have a whole set of language to describe them. Well, we're saying, actually, no, we need to actually describe them for who they are, which is very, very entrepreneurial nature. And because we're also saying the individual is not the unit, but the household is the unit, therefore entrepreneurial households. So that's the construct within which we started to use that phrase, and today it's shaping and defining our strategy. And what we're saying is the last 20 years went from bottom of the pyramid to entrepreneurial households, and the next 20 years is going to be the dramatic growth and contribution to economies around the world, particularly in the emerging markets, of entrepreneurial households. That's our thesis. That's our hypothesis, if you will. And that's the way we see the next 20 years.
Now let's talk about something that really fascinates me, and that's the Elevar method. You spent over 15 years building what you call equity for equity. So take me back to those early days. How did this method first start taking shape?
Scott, I'll give you the slightly complicated answer on that. The best thing to articulate strategy is 2020 hindsight. It took a failure on our part, a company which went down, which should not have gone down. Then for us to ask ourselves the question, why did this company go down, and why did other companies that have done well continue to do well? And from there came a few frameworks that have then subsequently become very, very dear to us, very important strategically, that in their totality are the Elevar method, if you will. Now, we have different language to use for each of these frameworks. That's fine. But let me give you the couple of frameworks which are very important. One is a framework I already talked about it. What is the need of the customer? Is a business model capable of delivering it? Who's the right entrepreneur to build that business, and can you scale that dramatically? Because that gives you both the impact and the commercial returns. So that's a key part of what we call the Elevar method. The other dimension of it was a recognition that we needed incredible discipline to build these companies. And let me give you first the reason why you need this discipline. If I go into a market which is largely informal currently, and I say, here I am, I'm beautiful, I'm going to actually tell you a better way to lead your life. So stop the traditional methods. So go away from the money lender, if you will, if I want to use a funny financial services construct, and now come and take a loan from me. Or go away from your traditional buyer of your agricultural produce and come and sell your product to me. I have to succeed. I have a responsibility as an organization to succeed, because I am telling them not to use a traditional construct that they have, but to come to a new construct, because I'm delivering it more affordably. I'm actually giving better quality. And I believe that, it's worth their journey. So therefore, unlike in the tech world, where very famous tech companies have said, you should fail fast. I don't think in the impact space we can operate with those parameters, because if we are disrupting traditional social capital that people have and households have, it's very important that companies succeed. So we said discipline is very important. So what does discipline mean? Because we're an early stage investor as Elevar, we're saying the first 12 to 18 months with a few $1 million, demonstrate your distribution economics, your unit economics, that your business model works. Don't try to grow and scale. Focus on that few branches on the ground, or those few clinics on the ground, or those few schools on the ground. Can you get them to break-even point? The idea out here is to identify a replicable break-even unit that you have a degree of predictability with it. So that's one. Once you do that, start to invest into building your organization. So now think about augmentation of senior leadership. Think about risk management. Think about governance. Think about the wires of the organization. Spend another 12 to 18 months on that. You're probably raising another round of capital to be able to do it. Now, what have you done? You've got a replicable unit, profitable, and you've got an organization for scale. Now, grow. The beauty of an emerging market like India is that you can do that first phase in $2 to $4 million. It's not expensive. You can do the second phase in $5 to $8 million. It's not expensive. Now, you think of a US VC style deal. What can you do with $10 million today? If you want to go into a high scale journey, not much. But in our space, we can get a proven business model, completely open market, which has millions of customers, and we can build an organization to meet those millions of customers for $10 million to $12 million. That discipline is very important. Now the question is, what am I going to raise after that $10 to $12 million? I'm going to raise now as much capital as is needed to go after as much of the market that I am capable of based on internal capacity. So there are 3 phases of company building, what we call building enduring companies, so that we're mitigating the risk that we will just not collapse by experimenting too much, because we have a responsibility to build enduring companies and not companies that fail very quickly.
Could you walk me through a specific case where you saw these pillars work together in a particularly powerful way?
That's the failure I'm talking about. It was a company we invested in Fund 2. It actually was an unusual investment for us, because we actually were not the first institutional capital. We came in later, and we looked at the numbers, and the company was profitable and it had a great story. It was basically raising growth capital to go into new markets. What we completely missed, and today with hindsight looks, oh, how could you have missed it? It's very obvious. But at that point of time was a tremendous learning opportunity, is that the 80-20 rule was relevant. 80% of their existing units were contributing 20% of the revenue and vice versa. So when they expanded into a new market, they expanded the good and the bad, which essentially meant that most of the units they entered into in the new market were not contributing revenue. Now, what was the problem? The unit economics had not been established very clearly. But when you aggregated the 100 units on the existing strategy, it was a profitable business. But when you scaled it, now suddenly it was no longer a profitable business, because you didn't have a replicable, profitable unit that you were actually scaling. So there was a fundamental flaw. So that's the postmortem we did when we lost that company, compared to some of the microfinance investing that we had done, where we hadn't lost companies, even though we'd gone in earlier. And when we did the analysis, came down to these 2 frameworks, which have become, we use this in every opportunity today at whichever stages of investing we do, is we're consistently trying to answer these questions. And it's very true to how we operate. I think it's very important to note this. Every company within the portfolio, we're constantly evaluating which stage are they. So when we invest, they're likely in the first stage. Have they moved to the second stage? We're asking ourselves on a quarterly basis, have they moved? And if they move to the next stage, then what's the capital? Then how are we building to the third stage? And then in time, one change we made is we added a fourth stage, but that's an investor lens. It's not a company lens, which is at some point you have to dress up for an exit for us. So we said it's a 4-stage process as far as development is concerned. But the example I'm giving you is an actual example of failure, which informed this level of thinking and strategy.
It's an important tuition payment to the School of Hard Knocks.
I'd
like to zoom out a bit and walk through your investment strategy at a high level. What I find really interesting about your approach is that you're laser focused on India and Latin America. And within those markets, you seem to have organized your investments around 4 specific themes. You've already alluded to them: financial inclusion, MSME, which, the financial world, we have all these lovely acronyms. So for people wanting to know, micro, small, and medium enterprises and market linkages, education and employability, and agri supply chains. How did you identify these as the key opportunity areas?
Scott, I'm going to repeat myself. Spend time in the field. Talk to customers. That immersion.
Just talking and talking.
Talking and talking. I mean, this month itself, I'm going to spend 3 days in the field. So a lot of investors do, in quotes, field visit. That's in the context of diligence of an organization that they're looking to invest in, or diligence of an existing portfolio company. We're very often going into the field just to go into the field, to feed our investment strategy and our thinking.
What factors, though, when you're out in the field, help you spot these overlooked opportunities?
That, I think, is the real, maybe where the secret sauce lies. So it's very difficult to put it in very tangible terms. But let me give you a sense of what happens. Sandeep goes into the field, has a bunch of conversations. He comes back to office. He's talking to Jyotsna and Vipul and Joanna on some call or in person and saying, this observation came up. And then there are a couple of other members of the investing team make another field visit. They're now fed this little input. They go out into the field and we start to see a pattern of that conversation with the customer saying X. Then it becomes real for us. And then when that X has become real, then we're spending time unpackaging that X. What does that mean? Is it real? Is it true? How do we test it? Do we believe that this is going to be a 10 to 20 year journey if it's an investment idea? Or do we believe that something is commoditizing so quickly that we should actually be looking for an exit of an investment? And we're kind of like doubling down on this. So this is a very practical, there is a weekly conversation internally that's happening on customer, where anybody goes on to the field is actually coming and saying, this is what I would repeat, it's not they going with the structured questionnaire. This is not market research in that classical sense. This is anecdotal, this is experiential, this is immersion. But all of that comes together into this big churning, melting pot internally, if you will, and then things come out of that.
Trying to understand customer aspirations, priorities, challenges, their spending patterns. Paint a picture for me. What does this actually look like? When you say you're in the field, are you having dinner at their house? How are you getting this data, which seems to drive virtually everything in your business model? Actually, it's your secret sauce, so to speak.
Yeah. So over the last 20 years, it would be, you're right. Lunches, dinners, cups of tea and coffee, conversations in households, being invited in, meeting people at their business locations, small businesses, micro businesses, meeting people just driving on the road and chatting with them. It's all of that. But increasingly now, data is available on economic activity on the ground in a way which is actually very, very tangible. It's not been historically available. So we're now beginning to use data tools and all of that to supplement, complement, drive those conversations in many respects. And build increasingly, it will be both the human dimension as well as the data dimension in terms of understanding those insights on the ground. Because I think we have a unique vantage point based on the last 20 years on how we can have these conversations with the end customer, which I call always customer, over the next 20 years.
What does impact investing mean to you personally? Because many people are using this word, and I'm sure all of these experiences that we've been talking about gives you a unique perspective when you're working exclusively in the emerging markets, and it drives what you're doing with your life.
My very first consultancy, I don't know, it's 1991, at that time. My first job was, first country I had to go to Costa Rica. That was part of the 40 institution we had to cover, and it was Costa Rica. And I remember it was the first time I was out of Europe. My Spanish was very bad. I arrived there. We started to work. We worked until Saturday. But there was a Sunday and I had off. And on that Sunday, first Sunday actually, I said, okay, if I have a bit of time, I went to a taxi driver and said, okay, please bring me to the poorest area. Actually, I mean, Costa Rica, outside of San Jose, Costa Rica is not the poorest country. But at that time, I'm talking back in 1991. I said, bring me please to the poorest part of San Jose. And he did that. He said, you should not go into this area because, there's a bit there. But I said, no, I want to go there. And I would like to ask people just to learn. And I went into this and I asked, it's Sunday, but these people work on Sundays, there's no Sunday, life continues. And I asked them, what does it mean for that? I mean, what is it actually? Just listening to the people on the ground. I personally have to say, I learned something, which was then, of course, I saw it many, many more times later. But at that point in time, it's all about the opportunity. I stick to this since today. I have to say, even in our vision statement here or in our purpose, it's creating that opportunity for somebody who doesn't have an opportunity makes all the difference. And I have this, you asked me on impact. For me, look, I know these days impact has developed and, there's SDG, there's all type of things out there. But when we come to, in simple words, let's say people who are really at the bottom, of the income pyramid, poorer people in these countries and the way they grow up, they are so limited very often opportunities. And it's not only finance, it is education, it's healthcare, it's many other things. There's no access to this. And I'm telling also still today, I'm telling people, investors here, don't forget, having an opportunity or not having makes all the difference for these people. What people do with the opportunity is a different thing. It's like in school, you teach 20 people and some people do great things and other people do less great, but having that opportunity, accessing and financing is as much as we can say financing is it, but financing for people who have so limited resources and say, okay, now I get this $200, $300 at that time. Today it's 500 or 1,000, but let's say that is very powerful. Now, it is also bad things can happen. All that type of things can happen. It's not without problem, but I'm saying, who am I sitting here, growing up in Germany, even going to a boarding school, having good education, all of that. Who am I to say, but these people, it doesn't matter. No, it matters for them whether they have a new opportunity. And for me, when we talk about impact in emerging markets with regard to how can we include more people into the opportunities, it's all about this, which makes a big difference. And yes, we can then put many complicated metrics around this and do things. But ultimately, it's about creating these opportunities for me, for people. Of course, when we now talk about climate finance, there's other type of things which come into play. But in a nutshell, where I grew up with seeing the reality of these people on the ground and saying, okay, what can we contribute? And that's also in the name of the company, responsAbility. The A is about, there is ability on the ground. And we also, what can we do that people can use this access to opportunities? And I'm talking about financial sector. I can talk about access to energy, clean energy. I can talk about access to healthcare. I can talk, there are many of these things. That is where in emerging market, I think the core impact basically happens.
Thank you for that, because it's a word that everyone's using. And of course, it's the focus of what we're talking about today, but it's important to define what it means to you personally. Now I want to talk about responsAbility. I did have a question. Were you there or in the room, or were you part of naming it since you were on the core team originally? Do you know about the development of the name responsAbility?
No, I was not in the room. Actually, the name was, so to say, invented by Klaus and Ivo. And Klaus always, he came also, he had a marketing background. He came, financial sector and he had quite a strong side on the market. And it was kind of, putting this two things together. There is ability and there is a response. Can we respond to these abilities? That was the thinking. you can imagine because this capital A and responsAbility. So many people have been complaining about this because when you typewrite it, it's always with an EI, it always makes it complicated. But that's where it comes from. That's the origin of the idea. And therefore it's, still today when we talk about purpose or vision, it's this, we envision a world where is access for all. There is this opportunity for all. That's what the company ultimately stands for and where we try to contribute. We know we cannot do it alone and we know we can only do a small part, but that's what we try to achieve.
So let's talk now about responsAbility. And I'd like to start with the theory of change and the problem or the problems that you're trying to solve.
This is key. If you want a challenge, a problem, a limitation on the ground. So we see, I started working on the ground. I worked in nearly 50 countries, looking what is the topic on the ground. And we have now, of course, a lot of people who are who work and observe this. And from there, we say, okay, there is a problem. For example, access to finance, but there's not access to power. There are still 500 more than in Africa, more than 500 million people without any connection to the grid. So there is a topic. So we see something and then we ask, we don't try to put this too theoretical. We see something concrete. The next question we ask is, are there companies which can positively contribute to overcoming this? Because we are an investor. We are an asset management house. So when we don't have the opportunity to invest in companies which can contribute positively to this, we can observe the problem, but we cannot overcome it because we cannot do so much about it. And so only when we see this, and we have, clearly we started on the financial sector side. Very often people ask, why did you start with microfinance? We started with microfinance because it is access to finance is an issue and it still is. And there is, and here's very important, there is an investable universe of companies because otherwise I cannot go to the investors here in Europe and say, look, I have an investment opportunity because you need to have a universe of companies. Otherwise it's not an investment topic as a theme. And so we start from something concrete problem and the investable universe. And then we ask, can we combine it with the investor interest? Because it doesn't help if we have something, but unfortunately, let's say the returns or the risks or so are not in line with what investors are looking for. So only when we can bring this together, then for us, it is basically what we call an impact strategy and an investable theme, because otherwise it's more talk than anything else, because we cannot bring all these elements together. And so in each of our offerings over the whole company lifetime, in the more than 20 years, each of our offerings had a very clear impact narrative. It's very clear what we want to achieve. For example, in simple words, I could say we want to contribute to a more inclusive financial sector development where more people are included into this opportunity, having access to financial services. That's the thinking. And therefore we are financing institutions which contribute to this positive.
I'd like to start with a high-level overview of responsAbility, its mission and investing focus, and what asset classes are you investing in and so forth.
Very simple. The company has a clear vision. We envision a sustainable world with access to opportunities for all. That's what we envision as a company. And the mission, like the way we do this, and the wording is, but we create products, investable opportunities for different type of investors, private sector investors, public sector investors, to basically make available for them investment opportunities, which all flow into emerging markets themes, the themes which I mentioned earlier. That's what we as a company do. And this hasn't changed over the 20 years now. Company was founded 2003. When I look today we manage $5 billion, to put it at $5 billion US dollar. We have invested over the 20 years more than 15 billion. Yeah. And all goes into emerging markets, or all goes into markets where still, of course, where you would say, yes, here the problems when it comes to poverty or when it comes to access to education, to healthcare, are large. All our investments are done in 3 themes, and we typically structure products along those themes. For example, climate finance mitigation can be a fund, or energy efficiency can be a fund offering, where a product offering where investors who invest into the fund know all the money goes into this direction and it supports, let's say, climate mitigation measures or adaptation. Or we do sustainable food, or we do financial inclusion. We do, from an asset management perspective, we only, with some little exception, only do private markets. So we are not invested in listed stocks or bonds. There's one product where we do this, but that's more the exception than the rule. Our strengths, and 98% of all the assets, private market. And in the private markets, we do private debt and private equity. We do both. Yeah. So if you want to, in a nutshell, the company is a specialized asset management house. In today's terminology, an impact asset manager with focus on emerging markets and with focus on creating access to opportunities for people.
So of this 5 billion in assets under management, which is enormous, how would you split between private debt and private equity? Because you make it sound like you're listed debt, and I think you also invest in fund of funds, but that's very small, I imagine. So today we should really focus on private debt, private equity. About what percentage do you have?
Private equity is roughly 35%, and private debt, 65%.
So these other two are very, very small. And then you made a point of saying not at all on listed equities. Tell me why not?
Our vision on admission is all of our investments which we do contribute to these developments on the ground in these markets. Now, most of these countries and the companies where we need the companies to invest are not listed companies. So if they would be listed companies, that's a completely different thing. But in these countries, what we call the capital markets are not yet so developed. What we call the investee companies, so our partners in the countries, because we don't invest directly in people, we invest in companies. The partners in these companies are, to the largest extent, are private companies not yet or not listed. Some of them will never be listed. That's one. So you have to go to this segment. You have to play in the private market in these countries if you want to broadly contribute. Yes, some of our investee companies, we invest equity, and over our investment period, they list on a stock exchange. In India, for example, this is the case. We have a couple of those cases when this happens. That's a good thing, but when we want to build a portfolio, a broad portfolio, we could not build this portfolio only on listed stocks. That's one. The second argument is a different argument, is an argument which is important to make. When you invest in a listed stock, you have to be very clear. It's a secondary transaction. I mean, when you buy shares on the stock exchange, somebody sells. So that's the logic of it. It's not like you participate in an IPO. That's the exception. The normal thing is you buy shares, somebody sells. So from that perspective, your impact on the real economy is very different from when you do private market investments. Because when you do private market investment, there's a loan, for example, which goes into the company, and this loan helps the company to grow the balance sheet and to do more under their business model. And so when you look from an impact perspective, there is a big differentiation between impact through private market investments, equity debt, or impact in listed markets. To put it for people listening or interested in this, I would even go so far. Look, there's nothing wrong. And of course, the majority of the investments happen in listed, in public markets, obviously. There's nothing wrong with this. It's just people have to be aware that, of course, you do that. The real world impact is very different from when you operate in private markets.
What regions are you active in, and what countries do you have people on the ground?
Investment wise, as we speak today, we are investing in around 70 countries, roughly. Where are these countries? Asia, Southeast Asia, Central Asia, Africa, Latin America, also Eastern European countries. So that's the large landscape of countries. Yeah. And yes, for doing this, we need people on the ground. We employ today roughly 270 people, roughly. Half of them are on the ground, or even more than half of them are on the ground, and the other half is in Switzerland. So we are headquartered in Switzerland. And when I say on the ground, what do I mean? Yes, I mean, we have office in Lima, we have an office in Nairobi, we have office in Mumbai in India, we have people in Singapore, we have people in Tbilisi in Georgia. So we need in these locations people with local insight, local know-how, language also. Language is, of course, for us very important. What we mean when we say on the ground, to identify the investment opportunities, but also to carry out the investment opportunities. And so that's how we are structured. And each investment which we do we have a direct relationship with the investee company.
And how many funds do you have? Because I think you have a lot.
There's a lot. We have more than 50. And we're saying, people say, oh, you should know exactly. But the point is, yes, look, it's a large landscape which we developed. Yeah. There is a number of funds which have the topic financial inclusion. There are a number of funds in climate, either energy efficiency, or there are funds where it gives access to energy. These are different nuances, different funds managed for this topic. Or, for example, a fund, and I just come out of a meeting with people talking about climate smart agriculture. So this is about climate adaptation investment. So it's a super important topic. It's not so easy to make it investable. And then, there's financial inclusion. There's sustainable food. Yeah. So we do investments in sustainable food, specifically, on the private debt, but also on the private equity side. And so we have developed that landscape. All of those funds are, if you want, so you could say these are thematic funds, because what we do, because it makes things also for the investors easier to understand it's not an impact fund. These are all impact funds. But when you are an investor in these funds, I invest with the objective of access to energy in emerging markets. That's my theme. Or I invest with climate mitigation in mind in emerging markets. And there are many investors, institutional investors, but also private sector and, private people, like us, who are looking for these type of investment opportunities. And then to say, I want to have something in climate. And then it's easier to understand. It's not a mix of things where everything comes together. As I said earlier, we identify a problem as an investment opportunity. We look, is it investable? Very important to mention. It's not impact first. So what we do is we ask ourselves, is the risk return profile good enough for the invest? Because this is very important. There needs to be financial sustainability, because if it's not there, it's either not interesting for the investors, or the company cannot provide the services over time. So it's very important to include this type of things. But as we look at only companies which have a very specific business model, you have basically the impact always built into this, because we select already the companies from the beginning under a certain criteria.
I would like to now drill down on impact, and I feel that responsAbility has a unique approach. And if I've done my homework right, there's like 3 layers. The first is incorporating, as you've already referred to, an ESG assessment for risk mitigation. And secondly, there's an impact assessment that seems to assess impact capacity. And then lastly, there's an overlay of technical assistance and advisory to maximize results. I presume this is something that's proprietary that you've developed over the years. Is that true? And how was it developed?
It's not like there is not one unified approach for each investment. There are certain elements which apply to all investments, all. Others, you mentioned the technical assistance, is not applied in each investment, in some, but not in each. So the framework is this. First, do we have on each fund product a very clear, well-identified impact objective? Yes. This defines the universe of investable counterparties. When we do then go into the process and analyze, we see whether, and this is a long list of criteria, depending on the topic, does this counterparty fill that equation? Some do better or not so good, but is our minimum achieved? Yes or no? That has to be looked at. Then comes the traditional ESG assessment, environmental, social governance aspect, which we look into, where we also have to have a clear picture. Where does the company stand on this? And then comes also parallel to this is what I call the financial. It's very important to mention the financial analysis is super important. Yeah. So for us, like as we are, you could say it's not your responsibility is a thematic investor. Yes, we do themes. So therefore, the understanding of what do we try to achieve with the fund is driven by a theme. And this makes it easier to apply a set of criteria, because when I talk, for example, about financial inclusion, I think we have such a broad, deep understanding of what we are looking for that we can be very precise on which practice in financial inclusion is for us, so to simply speak, a good one or not so good one. And to differentiate there, what do we want, where do we want to be, and where do we don't want to be. But that's something which you develop over time, over years. And so we have this and develop this, of course, for the 3 topics. And each new topic which comes up or might come up has to go through a process of developing these criteria, because the real critical things are in the nitty-gritty share, in the very specifics of a sector. And it's that can be very challenging and very demanding.
These authorized funds or the criteria list, there's, I presume, established when you set up a fund.
Yes.
But this incorporates both the financial ESG assessment as well as the impact assessment, right? It's a combination. It's not iterative. It's not one or the other. So then in the impact assessment, you give each of your prospective investments an impact score based on something you call the 5 dimensions of impact principles. So
we do, we can, when we have a system, where we score, there is more, but this is, if you want, so more fast for the internal processes, you see where the companies are. But the very relevant part is there are typically in the different themes, there can be situations where you find out something about the company where you say, no, this, even the other scores are good. The other parts are good. They are scoring high, but they are missing one element which might override the whole score and say, okay, no, this is not good because of this specific problem. And therefore, scoring, one has to be careful there. We do this, but it's not so simple that you say, just a score and it comes out, because specifically, when you get into a business model design and you get one element not right in it, that can be disastrous. And therefore we have to, be flexible in the interpretation of this. And that's the way we do this. Yeah. For example, when you pick financial sector, financial sector developments is sometimes criticized. Oh yeah, of course, it can lead to over-indebtedness. You provide financing to people. This can lead to over-indebtedness. That's a problem. And we are very aware. So therefore, it's super important for us to understand what is the analytics this bank applies to deal with and to avoid, to mitigate these problems. So we have to understand that part. It's a very important part. And so we design these type of, criteria because we need to know that when we invest at that point in time, we think they are doing the right thing. Things still can go wrong, of course, and we have seen it. The companies can fail for many reasons, but we want to see that, the approach is an approach where we say, look, it's for us, it's good enough to see that this company qualifies under our criteria.
If I understand you correctly, it's not really like you have these 5 dimensions and you come up with a weighted average score. It can be missing one thing that knocks the whole thing out,
Yes.
right?
Yes.
Right.
We can have these scores and averages, but I'm not a strong believer on the averages. Important thing is, are the key things fulfilled, yes or no? And there we dig deeper.
Once a company has passed this stage, then you move to the ESG assessment.
Yes, it always follows, and it basically, the things happen in parallel. We look into this. And again, on ESG in emerging markets, you might find, I take, for example, governance. Let's take governance as the G. You might find a company where you say, whoa, there on the governance level, there are some question marks. They should improve. Now, the question is, do you exclude the company, or do you say, oh, the company probably wants to improve on governance. So can we use also our financing to push the company in the right direction? So you see, it would be too simple to say, oh, the company scores low on G, oh, we can't invest. So as we are in development investment, so we try to develop things. It's very important to understand that you cannot just say no to everybody, because we would find a lot of no's easily. We have to see, okay, but is this a partner? They understand where we come from. Why are we asking the question? They understand it, or they see, okay, here's something we want to improve. Can we include it into our collaboration? It can go even into a loan contract. And there are different ways of doing with this, because we want to basically, we are partners also in their development. That's a very important part. Yeah, it's not just simple saying, okay, we invest, we don't invest. It needs all of this.
A lot of these companies, in fact, all of them are privately owned companies. So this isn't in developing countries. So this isn't as simple as going to MSCI and getting ESG data. Do you have to collect your own data, or how does this work?
I very often say it's handmade. So what do I mean by handmade? It means, yes, there is somebody of our people reaching out to the company, collecting that reaching out means visiting, doing due diligence, or all these type of things. Of course, once we have established relationship, things can be also done over calls and sharing information. Yes, we have to collect the data. We have to do the assessment ourselves directly, because we cannot buy this data on the market.
So then you've got this impact assessment, ESG assessment. Then what happens at that point? Then it's time to decide.
Yes, then it goes always into, it's different process. Let's say put it simple, investment committees, people look into this, and the decision is taken. Yeah, typically this process can be longer, depending, there might be some private debt deals where we already work with the company for 10 years. We have some clients for 10 years. Of course, the process is easier. You do the third transaction with the client. We know each other. It's different, right? It's a new client, or you do an equity investment. Process goes much slower. It's much deeper analysis. It takes much more time. But that's what we do. And that's what our investors pay us for. To spend time with the companies, to put our know-how into this and say, look, we looked into this and we come to the conclusion this is a good investment under this topic. And here we go. And then we invest. And when we invest, of course, when it is a loan, there is always information flow over the term of the loan. When it is an equity investment, we are typically, of course, actively involved, because we are, for example, on the board of directors of that company, basically in most of the cases where we invest. That's a very different level of engagement. Yeah. Just to mention, and I didn't say this before, and I don't want to confuse people, but we do also, with one line of business, we do fund investment. So we do really, in your terminology, probably it's got indirect investment. So we invest into other funds. So like a fund of fund approach. There's very deep engagement with the fund managers, but it's again on a different level.
And you have advisory team that supports these companies once you make an investment.
Our people on certain topics now have also broad insights, and they can share a lot of best practice. And so, but there might be situations where basically we see the company has a need in a very specific topic. We cannot afford to have a huge advisory team because we cannot afford. But what we typically do there is, over the years now, of course, we have a broad network of consultants. And so you say, this company has a very specific need on a very specific topic. What we do is kind of look, hey guys, you can work with these type of consultants. And we bring in the consultants very often and say, look, these are the guys you can work with. And so this is actually an added value for the investee companies, which is highly appreciated. Because imagine we have the big luxury. We see in 70 countries, 300 companies, we see a lot across the country. And of course, when I sit in, let's say I sit in Indonesia, I know locally what's happening. I don't know what's happening in Peru because that's very far away and it's a different world. And so the access to information, how are people dealing with this problem in the other parts of the world? That know-how sharing is a key part of what we do also with our partner companies.
You've talked about these partner companies. We've just been through your whole investment process. Could you make it real for me with maybe an example from the private debt and private equity so that people listening could understand exactly what kind of company you're investing in or lending to and that they're on lending or on investing?
For example, if you take food, sustainable food, equity, you say, well, imagine there's a company in India who has built a network of thousands of smallholder farmers, collects basically their production and then processes and distributes the production of these smallholder farmers. So what's the topic there? There are two things. Smallholder farmers, including them into the formal economy, that are one, food production. And the other thing is this company, for example, I have a company in mind which I like very much because they provide training to the smallholder farmers on sustainable agriculture. So through that investment, we basically achieve that sustainable practice is applied on a much broader scale in this case, India and Africa, but they do it in both continents, India and Africa. And so that's what we like about the company. So it's a very concrete case. What do we do there? We do equity and we could also do debt and put that debt. So both are, but that's a very concrete, another one. If I jump to make it concrete for people, imagine you are in Vietnam and you are working with a company who specializes in renewable energy projects. What they do, and we have quite a number of those, they work with local companies in Vietnam, in the region, who say, okay, I want to do a solar power installment on my roof or, what we call commercial and industrial renewable production. So C&I. So this company has specialized in identifying locally companies who want to invest into renewable energy. And this company needs financing because they buy material and then implement for these companies renewable installation, which contributes to have a better energy mix and to avoid CO2 emissions, because otherwise this renewable energy would not be available. So we then finance long-term this company, that this company can operate and do more renewable energy installations in the country, as an example.
Once you make these investments in companies like you've just given us examples, how do you track their impact post-investment? Do you have KPIs? I imagine they're different than the ones you maybe analyze them on. Maybe
it's not so different. The KPIs for a renewable energy production, installation company is different from a KPI from a smallholder farm. It's different KPIs. But we basically know what is key. And I'm a friend of simple approaches. This is already what we are doing is complicated very often. So it's very important to understand what are the key metrics which really matter for achieving an impact. For example, when you are in mitigation, you want to see that a certain amount of solar installation has been implemented, because this will contribute to renewable energy production. it's a chain which you can follow, and you know exactly when this is. The sun will be shining. Yes, you still have to make sure that are these installations in operation? Yes, no. I mean, you have to make some checks, but you know when this happened, and it is, you will get the impact which you are looking for. Climate is sometimes the easier one. When you work on inclusion or things can be more complicated. But what I only, and what, is, to be very frank, in the whole industry, most of what is done when it comes to impact measurement is output measurement. And it's very important to understand there's nothing wrong with this. That's okay. I'm offering insurance services and, okay, how many people do I reach? That's an output. That doesn't not anything say about impact. It's just, there is a new opportunity and people are using it. Very important, Scott, to understand. People buy the service. Now, when you buy an insurance or you buy, if you want, so you take a loan, you pay for it, or you open a bank account, but you pay for it. Now, very important, poor people, if there would not be a benefit for them, they would not buy the product. You have to really, and therefore I'm so much insisting on, as we are not in philanthropy, as we are not in subsidy and donation, we are talking same level, we are talking partnership. And when people buy a service, that's in itself already a very strong signal that there is a benefit. There is a benefit coming out of this. Otherwise, they just would not do this. And of course, the analysis doesn't stop there. But what I think is very important to understand, it's a business relationship. People have new opportunities which come through these offerings. Now they demonstrate that they are using it like a mobile phone. I mean, who buys a mobile phone? You can then say, you are doing this because yes, you want to use it for certain. And that's the same thing on these basic services because people have to buy these in most of it. And there's no an insurance system available and you just go to the doctor. Typically, even when it comes to healthcare, people have to pay for this. Now, this signals the importance of it. And therefore, in the measurement, it's super important you identify these key points, which are important, which give you an indirect indication. Now, after the indirect indication, and nobody is capable of saying, okay, now we measure what did it do with the people? I mean, if you want to, the outcome, or even when you go one step further, the impact, it gets on the measurement part, it gets much more complicated. And yes, it's useful to do here, there to see whether the mechanic works in the right direction. But otherwise, it's very important to keep it also simple and to keep it efficient. Because don't forget, I typically ask investors, I say, yes, you want more impact measurement. We can do it. It costs you 15 bips extra. Guess what? The answer which I get very often from investors is, no. Then we keep it simple. You see what I'm kind of the point is there is cost involved and somebody has to pay for that cost. Therefore, we really emphasize a lot, it's very important to keep things manageable because if it's not so, yes, you might have a better feel or more complete picture, but the reality hasn't changed. It's just very costly exercise at the end. So we are very sensitive there.
How does responsAbility think about impact and its relationship with financial returns? Have you found impact results always to align with or correlate with your portfolio's financial returns? And of course, we're talking about positive impact. Is there a linear correlation between the number of lives positively touched and the investment's financial return?
This is a complex topic. Let's say there's one bottom line there. When you invest debt or equity in a very successful means good business model and the company grow. And we have a lot of these companies, they grow very strong and have this business model. They are financially super successful. I mean, it's when you're an equity investor and a company is growing very strongly, profitable, that's a good financially a good investment. It is also by definition more impactful because it has a much bigger outreach, it contributes more. That's one line I think that has to be very clear. A company which has a super, let's say, beautiful impact model, but stays very small, very tiny, there's nothing wrong with it. It can even financially be okay, and it's fine. But one has to be very clear. It's still a limited impact. Yeah. The biggest impact, of course, to be very clear, is when a company demonstrates something and it is replicated by others. And very early in our talk, I said this enabling environment is of course, is very impactful, but that's not an investment activity. That's creating an enabling environment. Very, very impactful. When it comes to investments, sometimes in a country, you can have, and we have, I feel very proud also about, in some countries we get also in this, so to say, nice position. We bring a new topic in a country, we find the company, and the company says, okay, now I do an energy efficiency offering in the market, and it's the first energy efficiency offering in a market. The competitors see, oh, this is actually a very good thing. And a lot of clients go to this, in this case, a banking institution, and then they start to replicate this. Then, of course, you see, you basically move the needle with one investment in the market. That's where the biggest impact comes. Of course, these are more, it doesn't happen all the time. Not all the investee companies can be in such a position. We don't expect this, but you see, there is a lot of it. Now, your question is impact and return. Yeah. Look, growth, yes, a strong growing company has, by definition, when it has a good business model, also larger impact. And that just comes by the numbers. And it is the case there. But, like for us, super important is, look, there needs to be attractive return for the investors with the investment. Because if there is no attractive return, tomorrow investors will not invest in this. And then also the impact will decrease. Like you need to basically complete the circle. You have to do an investment. It has to be from an investor perspective. And investors are not only looking for the financial return, they also look for the impact they can have. But of course, the financial return is a necessary requirement. So they need the return. Think about a pension fund. The pension fund needs a certain return because that's a fiduciary responsibility with their pensioners. So they need to do this. And so you have to complete the circle and to provide, if you want, so that return. Therefore, we combine it with this business model where we know impact goes also with growth and with return.
But there was a day when people felt that to achieve impact, you have to sacrifice financial returns. But you're arguing that's no longer the case.
No, my argument is slightly different. What I'm saying is, look, let's say there is an investor who wants to do private debt. An investor comes and says, okay, I'm not so much impact. I want to do private debt portfolios. Are there more attractive private debt offerings available compared to what the impact, not only us, let the impact people do in emerging markets? Answer is yes. I'm very frank. Like I'm saying it's very important. Like what we do needs to be attractive. I mean, it needs to be also financially attractive, but I'm not saying, look, when an investor just goes for maximizing its return, and everything else doesn't count. I'm just interested in maximizing my return. Then there is, return means risk return. There is, of course, good arguments because some of our private debt portfolios are highly diversified. They have very low volatility. And when you have an investor who says, okay, I want to avoid risk, then they see, whoa, the beauty of these investments. But you see, the question very often in talks is put forward a little bit too simple. An investor is not only looking for maximizing return. For example, private equity. It's probably simpler for people to understand. Yeah, but when I want to maximize return, I go to a private equity house where I probably use a lot of leverage because that might boost my return. When you do, like we do private equity without leverage, you are building on the growth story. Yeah, you get attractive returns, but it doesn't have this element of leverage. So, if you compare these two things, now you can say, but the leverage is also risk. I'm comparing apples and bananas, so it's not the same thing. But you see what I'm saying is important is, are these investments which we do financially, risk return wise, attractive offerings for many people of private sector? And yes. Are there people who have other criteria and say, no, I want to have even more? They would then not invest into these type of opportunities. But it fulfills the equation of being attractive opportunity.
You became a founding partner at ABC Impact around early 2019. This was originally backed by Temasek, where you started your career over a decade earlier. And regular listeners to the show will know that we had Eliza Fu on the show a few months back, and that was a great episode. She's great, and everyone should catch up on that if you missed it. What was compelling enough about the ABC Impact vision to leave an established impact fund like Leapfrog to build something from scratch? And was there something poetic for you about returning to the Temasek ecosystem as a entrepreneur this time rather than being an employee?
So we have been incubated by Temasek and Temasek Trust. So Temasek Trust is the philanthropic arm of Temasek, and the two of them kind of put together a team of a few of us and really asked us to think about this idea of an Asia-based, Asia-focused impact fund that would address the pressing issues in Asia, in environment and social. I had already actually left Leapfrog almost 9 months before this opportunity came my way. So when Temasek and Temasek Trust reached out, it felt like coming home. It felt very privileged and very fortunate and also very empowering that an institution like Temasek and Temasek Trust were really looking at impact investing as a viable way to generate returns and, sort of amplify impact. They gave the three of us, David, who heads up our fund, David Heng, and Xiaoming, my colleague, the three of us were the initial set of people who started working on this. And obviously the tribe has grown. We had the opportunity to have really good backing of the ecosystem, a great ecosystem, a very long-term oriented ecosystem. And we had the flexibility of a small team where we could come up with the strategy, identify the themes that we wanted to invest behind, sort of do a market mapping of the opportunity set. We designed our impact framework from scratch. So in late 2018, we worked with Bridgespan together with Temasek and Temasek Trust to design what impact would mean for this fund. Again, it was a collective project. Eliza was part of that. So it was really a very unique opportunity to have long-term oriented backers, a really energized team, and it was an opportunity to do something for Asia. So it was really a very privileged position. And we had fun. We raised the first fund in 2019. And again, it was the experience of a first-time fund. You sort of go and you pitch, you put together a pitch deck, you sell your idea and sort of get the fund up and running. The other really interesting thing, which, it's a pan-Asian fund, which is again a very unique privilege to be able to sit in Singapore and invest in Southeast Asia and North Asia. It really just gives us such a holistic view on sectors, on regulation, and it really helps us make sort of a more balanced risk assessment.
That's a unique experience to build a fund from zero. Do you have any thoughts on what are the 3 or 4 most critical decisions you have to get right, let's say in the first 6 to 12 months? And where do most people building impact funds fail?
Obviously, the team is really important. We're a human capital business. The resource that we have is just the people. So having the right set of people with the market experience, the market track record, and networks, because a lot of this is about originating and getting access to the right opportunities. So I think the team is really important. I will say, having been in private equity now for 20 years, worked in big funds, small funds, I think line of sight to capital and backing is not trivial, right? Because raising a first-time fund, it's very difficult. There's a right size at which you can afford a good team, you can afford the infrastructure, you can give people careers rather than stints. So I think, when I started, I was always very conscious and grateful for the fact that we had the backing of a really, really powerful ecosystem that really set us off at a very different place than if we had done it ourselves or for other funds. So I think one of the reasons funds do fail is that it just takes a lot of time to get those first one or two investors together. The fact that we had those people who were sitting together with us designing just got us out the gate faster. And then the third thing is, I think, having a very clear understanding of where you're going to find this balance of returns and impact, because it's very easy to be attracted by momentum, to have to relax your definitions of impact. I think we always started with the market opportunity. So what does the market need? What are the issues that we need to solve in healthcare? What are the issues we need to solve in financial services? And then which businesses are well designed? So I think a more sector-based, thematic-based understanding. Our team is also structured on sectors. It just makes our analysis and our decision making a lot more richer.
That was 2019. You were managing director originally. Then in 2021, you transitioned from that to the chief impact officer at ABC. Now, that's a quite specific role. And when people hear chief impact officer, they might imagine it's a nice title for PR purposes. But explain to me and to listeners, what does your role actually entail, and what do you actually do day to day, and how has this evolved since 2021? Now you've got a few years behind you on that.
I'll start from what's important to ABC Impact. We have always been a fund that's focused on commercial risk-adjusted rate returns with measurable and evidence-backed impact. And I think the measurable and evidence-backed has been something that's part of our DNA. So when we think about our impact management, we've got a team of 3 people. I head up that team. So in addition to me, there's 3 other people. We spend a lot of time on impact assessment before we make the investments, and then on impact monitoring, reporting, and then impact evaluation at exit. That's what the team does. As chief impact officer, my job is to kind of make sure that this function gets the senior leadership, the strategic thinking that is needed to make sure that we are doing it in an evidence-backed manner. So just to give you an example, there's a lot of data points that are missing in Asia. So if you look at even public policy, when we were doing our investment in Kim Dental, this dental chain, just getting access to the information around number of dentists, number of oral hygienists, the kind of procedures people were having on the ground in Vietnam, it was really difficult. We had to conduct primary research, do our own surveys to find out or assess the actual need in the market or the unmet need, or understand how many people were underserved, what was the level of the population. So I think whenever we've done investments, we've been very focused on having a data-driven and evidence-backed approach to impact. And that's the kind of work that my team and I spearhead. All the investment professionals in ABC Impact, we've been very fortunate, are very mission-oriented. And again, because people are sector-focused, they really understand the needs of the sector. So I would say that even the investment team in our setup is very focused on impact, and that's how decisions are made. So my team's job is just to be the center of excellence, to make sure that we can have standards of practice. We can make sure the data is comparable. We can make sure that we build up those case studies and repositories. That's really the focus.
Give us a 10,000 meter view of ABC Impact before we start to drill down.
Absolutely. So ABC Impact is a growth-oriented fund focused on impact. We write anywhere from $30 to $70 million US checks for minority stakes. So we are not a controlling or a controller, a majority investor. We are very partnership focused, provide growth capital. We don't do any early stage tech product risks. So we're not VCs. We're very much in the mid-market private equity space. From a geographic perspective, we are pan-Asian. So we invest in India, Southeast Asia, and China. Currently, we've got significant number of assets in all these markets. From a sector perspective, we have 4 impact themes. I would say 2 of them fall under what people traditionally call social impact. 2 of them would fall under environmental or climate impact. So within social impact, we invest behind financial and digital inclusion. So this is helping people get access to financial products, but also help people get on the digital economy. So, if you think about markets like India, being able to sell your products online, get market linkages through the digital channels, way of making impact. So that's one of our focus themes in social. And then we invest in healthcare and education, which is our second sort of social impact theme. On the climate side, we look at climate and water solutions, which encompasses the whole space of hard assets like renewable energy, waste, recycling, and then climate tech businesses. And then we invest in sustainable food and agriculture. So those would be our 4 themes. We currently have 2 funds. Fund 1 is a 2019 vintage fund. It was $300 million US. That's been invested across 14 companies. We've exited 1 already. And we just raised a second fund, which we announced earlier this year, which is a 600 million fund. We've also added the Asian Development Bank. ADB is one of the prominent LPs who's joined that fund. And that fund will continue the same mandate, just, bigger ticket sizes, 30 to 75 million. We've already deployed, I think we've made 4 investments from that fund already, 3 in India, in financial services and healthcare, and 1 in China.
You have around 900 million assets under management in total. That makes you the largest Pan-Asian impact investor, no?
It does.
Most people in this space talk about balancing impact and returns as if there's an inherent tension. You talk about having no trade-offs, which, that sounds good, really good, and almost too good to be true. What's different about your model, and how have you structured ABC so that doing good and making money aren't competing objectives?
So I think the fundamental way we've done that is we've kind of identified themes where impact is almost correlated to business performance. So we look at businesses where impact is the impactful part of the business, or the impactful product and services that we underwrite are a significant part of that business. So when the business or the product grows, impact grows. So I think we've kind of solved it by selecting sectors where that relation is pretty well established. I would say that there are instances where these move in different directions, but we just don't focus on those. So we've prioritized sectors where business growth and impact are collinear, and that allows us to be more confident that, should we achieve business growth, profitability growth, impact will move in tandem. The scales may be different, but that's how we've kind of addressed it. We are very intentional about the sectors that we invest in. So within healthcare also, it's a very, very vast sector. We have naturally deprioritized sectors where this relationship doesn't exist, or where we feel there is technological or medical risk to the impact being achieved, and really just focused right now more on delivery, pharma, and a few other sectors where this relationship is established. So I think that's one way of ensuring that these two work in tandem. We do spend a lot of time monitoring. So we have a very regular monitoring framework just to make sure that should this relationship change, we are in a position to react.
Your approach, by definition, then does say that there are impact sectors that are underinvested in. And if everyone had your approach, there would be massively underinvested sectors, maybe on social justice side or something like that, that would never have this explosive growth that allows avoiding this tension. I mean, would you agree with that?
I would agree with that. And actually, in our first fund, we had an impact theme called Smart and Livable Cities, which was part of our original Fund 1. And as we sourced for deals and as we evaluated deals, we realized that for a number of these subsectors, the commercial risk that we are underwriting is disproportionate to our risk tolerance levels. So a lot of these businesses, for example, have governments as customers or governments as key service providers. So you're in infrastructure, you're in sort of cities, and that risk is a very different risk outside of Singapore. The Singapore government obviously is perfectly underwritable risk, but in different parts of Asia, having the government as a key stakeholder in your business economics is not always that straightforward to underwrite from a commercial perspective. So we did deprioritize, and for Fund 2, that is not a focus sector. So you're right that we are doubling down on sectors, and there exist many sectors which will remain underinvested because they don't have that disproportional risk. My only counterpoint to you is that we're a private equity product, and the definition of success in a private equity product is established already, which we don't have the privileged currently to rewrite. So I think, our success is measured in the traditional private equity sense also. So I think it's not unreasonable for us to make this decision. But there do exist sectors, I would say sanitation, hygiene, social justice, where this relationship doesn't exist.
If impact investing is truly the future, then why are most of the smartest investors in the world still pursuing traditional private equity and venture capital?
So I think what impact investing is saying is that the impact investing movement, which does have some really smart investors, is looking to direct capital to amplify these solutions, which can address some of our challenges around financial inclusion, healthcare, etc. So the mission is to direct capital, as much capital as possible, to these businesses that exist. I don't think we're saying that we can solve all the world's problems. And I think when you think about, there are a category of issues which require a very different type of capital. I think one of the differentiating factors of impact investing, which I feel we haven't talked about, that I'd like to bring up at this point, is the decision to make the investment, right? I think the underwriting of the investment. I think we as impact investors underwrite ex ante expectation of impact. So I think one of the things that we do differently from traditional private equity is we spend a lot of time before we make the decision to invest on actually taking a view or a hypothesis on the kind of impact we think will be achieved. And I think that's the difference between that intentional allocation of capital. Private equity also in certain cases has tremendous amount of impact, but that is a ex post impact. They could have invested in some businesses which have really changed the world, solved some crucial problems. But when they made the decision to allocate, they only looked at the commercial part. And I think that's where we are different, that we actually make a case that this impact will be underwritten. We track it. And if it doesn't make the case, right, our LPs hold us accountable to the way we allocate capital. So I think it's in the selection and in the decision making that we're different. And I obviously make the case that more and more money needs to flow into this space. But I'm conscious that not all subsectors or not all business types can achieve this kind of dual.
You organize your investment thesis around what you have called two sources of impact, the social and climate. And you said people need the planet thriving and the planet is impacted by people. These aren't separate buckets, are they? They're interconnected systems. So how do you think about this interconnection when you're evaluating potential investments? How do you assess the ripple effects across both these social and environmental dimensions?
People and planet, it's so intertwined, right? So I'll answer this in two ways. So when we think about impact underwriting, we underwrite impact on individuals and we underwrite impact on systems. For example, even in healthcare, we've put out some thinking around how we think it's important to invest in businesses that are helping the healthcare system become stronger, not just businesses that are directly treating a patient. And then we also look at the planet. So we've always had a holistic way of thinking about impact. In fact, one of our investments in India, which is in agriculture, actually has an impact on the soil, the use of water, but it also has an impact on farmers and farmer livelihoods, right? So I think from an impact assessment perspective, we have always looked at different stakeholders in each of these impact evaluations. I think where it gets interesting is the communication of impact, right? I think if you look at our decks a few years ago, this division of climate and social was not as stark as it is now. I think as some of the conversation has evolved to talk about it in these ways. But if you look at our theory of change, which we've put out on our website, you will see that our climate themes talk about impact on planet and people. So when we don't think about these two things separately when we do impact measurement.
You've already mentioned this, 4 thematic investment sectors, and they are climate and water solutions, financial and digital inclusion, better health and education, and sustainable food and agriculture. How did you arrive at these specific 4 areas for the Asian market? And how do they align with the UN SDGs, which are important to you as well?
So when we started, we actually we looked at the Council for Sustainable Development, BSDC's initial reports on what the gaps are in Asia and where the funding is needed. And that's how we started with the first kind of 5 themes, which included sustainable, smart and livable cities. So that was the origin of our work, where BSDC had put out reports sort of mapping the needs in Asia for these themes. And these were the four most important themes that emerged. Over time, we've been able to sort of refine our thinking within each theme to also map the opportunity set. Because one of the things in private equity or in investing is that you need to find targets or investable assets that can be backed, where you can deploy money. So what we've done is over the last few years, we've sort of sharpened within each of these themes our focus areas to make sure that we are focused on places where the opportunity set kind of maps the need set. So where does money needed and where we can find companies that can absorb our capital or where we can find founders that we can back.
You've made this bold statement I found somewhere in my research that Asia is at the heart of the global impact story. I want to understand what you mean by that and what makes Asia different from impact investing in other regions. And maybe you can comment on what do Western investors misunderstand about the Asian context that limits their effectiveness there.
I think the opportunity set and the problem statements, I would say, in Asia are the largest. We have the largest population living in this continent. We've got the most amount of development alongside Africa to achieve in the next couple of decades. So I think from an opportunity set perspective, this is the place to be. And we have, I would say there's two things I'm very optimistic about. We have Asian capital that's coming online to fund some of this growth. And we're innovating. I think one of the most exciting things about Asia is that, solutions that are being developed in Asia for issues in Asia are unique. We're finding different solutions. So I think one of the paradigms that needs to change is kind of the North solutions being applied to the global South. And I think you can see that in EVs, in battery technology, in battery swapping. There's different models coming up. There's different ways to solving the same problem. And Asia is innovating. So I think the opportunity set is big. The population is big. We need a fair amount of money to fund some of this change on the ground, which is why we think, Asia is kind of the place to be. I think if there was a message for investors that are outside of Asia, I would just encourage them to spend more time in the market, right? I think it's very important to be here, to see the optimism on the ground, to meet with the young entrepreneurs who are really building businesses to address some of these issues, to feel that enthusiasm rather than to evaluate from a distance.
Can you describe for me a couple of specific investments that exemplify ABC's investing approach in real life? Maybe you could just walk us through and pick a couple from the different thematics that you are focusing on.
Yeah, sure. Maybe I'll pick one in each geography and then kind of take it from there. So in China, we have invested in a company called Da Mi Xiaomi, which basically means big rice, little rice. It's an autism rehab therapy chain. It's very unique in the sense that it was started by a founder who is a mother herself, and her child was diagnosed as being on the spectrum. And then when that happened, she sort of started looking out for products and services and therapy providers who could help her. And she identified this need, this underserved need of not having high quality therapy services available in China. She started this business, which provide 1:1 therapy, but also 1:many therapy for kids within the age of 3 to 6, which is when the intervention is most impactful. We came across the founder. Our team sort of was tracking the space. They found the founder, again, very mission driven, very focused on addressing the core problems since she had experienced it herself. Worked with a teacher to adapt the curriculum to the Chinese culture. So a lot of work around the ABA curriculum went into sort of localizing it for that context, for that society. That's been a tremendous experience for us in terms of, underwriting impact on kids, working with them on how to measure the impact. The experience has just been super enriching for the team. So that's one in our sort of healthcare space. The other investment that's been really super interesting is Cropin, which is an Indian cultural technology business. So this is in our sustainable food and ag space. So the Cropin founders founded this business in 2011. That's almost 14 years ago, where the idea was to use technology to help smallholder farmers solve basic agronomic practices, when to plant, when to sow, how to prevent weather challenges, how to deal with common pests, what kind of things to put. And they basically designed a solution that allows using mobile phones to get information on what agronomic practices to follow, allows them to get weather information. It allows people like Cargill or McCain to sort of track what their farmers are doing. So again, intervention for smallholder farmers, they produce 70% of the world's food, but if you look at their income levels over the last few decades, there's hardly been any change. So this is one of the really interesting businesses that addresses both social and climate impact. We originated this deal through our own network. We've got a whole bunch of people. We've got the Bill and Melinda Gates Foundation who's supporting the business. We recently got Google, who joined the cap table to sort of leverage the amount of data that Cropin has collected.
How do you measure impact in that sector?
Yeah, so impact for Cropin, actually, we've been able to track farmer level productivity. So because we have a lot of information, we've done a few studies to check the yield of a crop before and after using Cropin services. And there's been very positive results around farmers being able to do the right interventions to make sure that their yield can be better using the SaaS product. And we've just actually started in the last few years tracking soil health and tracking what's been grown on each plot of land. And that's another way to kind of get a sense of impact. It's actually pretty easy for IT systems. It's pretty effective.
So that's two sectors.
Yes. And then in Southeast Asia, we invested in Sunseep, which is a rooftop renewable business that started in Singapore and expanded into Vietnam and some of the other Southeast Asian economies. This business, we were able to exit. So the whole business was sold to EDPR, which is the Spain and Portugal electric utility company. We were one of the early backers in the solar renewable space. So again, an environmental deal in Southeast Asia that we were able to get a successful exit from. So those are three good examples across Pan-Asian.
You have 4 themes. Do you have one more example? Or?
Financial inclusion. Yes, of course. So we've invested in 3 financial inclusion businesses, 1 in China and 2 in India, which basically provide loans to small and medium enterprises. We have invested in iFinance and Vistar, which both address the MSME market, one of which gives unsecured loans and the other one gives secured or asset-backed loans. And then we've also invested in Chongo Bridge, which is the largest microfinance business in China, which provides small loans to farmers to sort of input into the agricultural economy for livestock, feed, produce, seeds, etc.
So I'm interested in that. How are you doing private equity in China and moving capital out? How does that work?
It's been an evolving situation. I think we are very focused on sectors where, we can see a very distinct impact and which are not directly related to any, government sectors. So our sectors are more in the healthcare space or in the financial services space, serving the underserved. I would say more domestic demand driven, more addressing needs in society. It's not been a straightforward market, but I think we're very confident. We have a lot of networks there. We've got people on the ground. So we continue to remain investing. We've actually invested in a business earlier this year, but we're cautious. I think we're focused on making sure that we can get a path to liquidity. We are looking at more cash flow generative and profitable businesses. So our risk underwriting has changed, but from an impact perspective, I think we continue to find pockets where I think our capital can make a difference.
Are you still bullish on China?
Yes, we're long-term bullish. We look at Asia as a pan-Asian market, and I think it's a great privilege. And it's also a way to diversify risk.
You've been backing mission-driven founders for over a decade now. I'm curious about pattern recognition here. What are the characteristics of entrepreneurs who can successfully balance mission with commercial viability? And on the flip side, what are the warning signs that someone is more interested in doing good or feeling good about their mission than actually delivering measurable outcomes?
This is a great question, and I'm just going to spend a minute telling you a story about our own ABC Impact team. So in ABC Impact, we have 2 stages in the impact measurement to mirror your commercial assessment, right? You have a first stage where you give a term sheet, and then you start diligence. So in impact, we have the impact screening process where we have a early screen on whether this company should we do more work? And then we have the impact diligence process. So when we were designing the screen, we tried to keep it simple and we tried to keep it sort of binary where people could answer yes, no kind of questions with basic information. and I am maybe a couple of meetings with the company. And one of the criteria in our screen is intentionality. And when we were designing the screen, that criteria was the one that people were most circumspect about, because they felt, well, it's quite qualitative. How are you going to measure intentionality? We designed some rubrics around, why have the founders set up this business? Who are the other people on the cap table? What kind of other people have funded this? So we tried to think about different ways of feeding into this intentionality decision. And we started with the screen and we said, let's go with it. We understand that it's a qualitative feature, but let's present it to IC. Let's talk about it. Let's talk about why we think this team is intentional and committed to the mission. And what we found over the last 6 years, and particularly during tough times of COVID, where some businesses really went through a roller coaster, it's actually people who indexed very highly on intentionality that have been the most resilient. Those founding teams have been able to pivot. Those founding teams have been able to make adjustments to the business model, but still stay in the same direction of travel for impact. Just to give you an example, we have an edtech business in India called Vedantu. Fantastic set of founders, teachers themselves, enjoyed a great tailwind in COVID, where adoption of sort of edtech solutions was really amplified. Saw a roller coaster dip once kids went back to school with a vengeance, once COVID was away, and then have now sort of found the new normal, pivoted their business, added a few different service lines. And really what's kept them going through this turbulent time has been the fact that they started the business with the intention of, revolutionizing education at scale. They're teachers themselves. So very, very mission aligned. We are very mission aligned too. We are very focused on the eventual impact. We supported them for doing some studies around outcome measurements for students during the post-COVID times. That's just one example to tell you that something that may seem amorphous or that may seem qualitative can actually over time be a very good indicator of, which founding team is going to be a great partner. And I will say that companies and founding teams or management are now pretty nuanced about asking investors these questions also. I think people have learned that, they want to find investors with the right mindset, with the right partnership approach. They don't want to find fair weather friends. They really want to find people who are looking at the problem in the same way and are looking at solving the problem in a similar way.
So that argues that mission-driven companies are more resilient.
I agree. We believe that. We're doing some work to make that case with data.
That challenges almost everything most investors believe about risk, where they actually believe that it's less risky to maximize profit than to do this balancing act.
I think when we talk about mission aligned, we're talking about people who are trying to solve the same end problem while achieving. I think we're not saying that they're not solely focused on profit maximization. They want that problem statement to be solved. I think for us as impact investors, it's really important. It's not an ideal outcome to have maximized profit, but not have solved the actual problem that we all set out to address in the first instance.
Why should an institutional investor allocate capital to ABC rather than a comparable fund focused on other emerging markets?
Well, we are pan-Asian. We are pan-sector. We've got a great team with more than 20 years of experience, each one of us. And we've got a great track record. So if you're looking to invest, please find me and I can tell you more about each one of those.
And what would happen to the world if every major investment fund adopted ABC's approach tomorrow?
We'd have some really champion companies, large companies addressing some of our challenges around financial inclusion, healthcare. We'd have some great examples to export to the rest of the world. A lot of solutions will come out of Asia that can find use in the US and in Europe. And there'll just be a lot of cross-pollination of technology. I think that's one of the technology is a big enabler. We don't speak about that much, but, the asymmetric impact that we are seeing in healthcare, in education, just using technology is something that we feel that the world can learn from actually, from Asia.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.